hello, my dear friends. This is your friend Vivek Bajaj, co-founder StockEdge and Elan Markets. Friends, let me welcome you to this amazing face-to-face global I'm going to record today. And this one is going to blow your mind. Trust me, watch this till the end because today's guest is very special. I have requested him to look at Nifty stocks, Indian stocks, and explain the concept, which is his concept, apply them on Indian stocks, and help us know how he analyzes the market and how he trades the market. He's someone who has an experience as a trader, as a teacher, and whatnot. Right now, he's also guiding other people to do right things in the right way. So let me welcome, without taking too much time, let me welcome Matthew Caruso right from Canada. Hello,
Hi,
Matthew.
hi, Vivek. Thank you so much for having me on the call. It's a real pleasure.
Thank you so much for accepting this invitation, and it's absolutely my pleasure to hear from you far away from Canada. Zoom is such a beautiful platform. Twitter is such a lovely platform that we all are able to connect together.
Absolutely wonderful. I think just a couple of years back, this would have been so difficult to do, and now we can have this great conversation online.
Yes, absolutely. So, Matthew, the format of face to face is that, one of the reason why I do this is to inspire people and tell them that, if X person can do this, you can also do this. So, your story is quite inspiring. So, I would like you to talk about your story first. And then, obviously, we are getting into the strategy. And I'm so excited you're going to talk about Indian stocks. So, that is like cherry on the cake. Let me hear about you, your story, how you reached here, what you are doing, and then we get into the strategy discussion.
Sure, absolutely. So it's always been a real passion of mine to be part of the market since I was a teenager. And like you mentioned, anyone can do this. I started my first trading account. I had money I made part time working at McDonald's as a teenager. Was my first brokerage account. But as I studied in economics in university, and I did my chartered market technician designation. And so my first job, fortunately, out of school, was as a market maker and professional trader for one of Canada's big banks, which was a great experience. At the same time, I was offered to teach a finance course at Concordia University. It was an undergraduate finance course, so I really enjoyed that teaching aspect of things as well. And so I've just basically my life has been investing, trading. It was a great experience to understand the market making and the professional trading because I really learned the very intricacies of the market. You know, the day-to-day flows of the algorithms and institutions, and it gave me a great insight. And I eventually decided to just invest for myself, which I've been doing for several years. In 2020, I got a little bit of attention. I was in the U.S. Investing Championship, and I had a 346% return. So that was a good year. And I've since then I've created a course where I teach how I approach the markets, and I have a membership where I kind of go over markets in real time with members. And it's been a real pleasure, and I look forward to discussing how I actually approach markets.
Awesome. And your students will be all across the globe, I believe.
Absolutely, there's actually many Indian students as well, so they've actually really enjoyed it, and they're happy members.
Nice. So maybe you will see one more student at least added. That's me. And I hope that you get more and more students and people should get mentorship from you. So let's
Definitely.
get on with the discussion and let's talk about how do you approach the market. You have done some great work for us looking at Indian charts. So you can do the screen sharing and we can continue the discussion there.
Sure, absolutely. Okay, here we go. So I just want to give a little bit of a background of how I approach the market before we actually get into the charts. So when
Yeah.
I first got into investing, my first very big influence was William O'Neill with his book How to Make Money in Stocks, and his focus was really growth investing, growth stocks, and that really laid the foundation of my passion for the markets. And one aspect that he did that I always found so interesting and unique to William O'Neill was that he used both fundamental analysis and technical analysis to come to his decisions.
Hmm.
And that's something that's always, even when I was market making, pro trading, I always tried to have both of those elements in my approach.
Hmm.
Now, with time, I learned a lot of very short term techniques, which I built into my process. And so now I have kind of this hybrid system that I built with time where I look for these very large, advances in these stocks that are growing strongly. But I like to use shorter term patterns just to enter the stock so I can keep my risk very much in check, keep my risk low, and I can build up a position over time. And so what was very interesting as well is I was able to go over the Nifty 50 stocks. I always love to look at other indexes as well to see how that works around the world. And it's very much the same activity, same action. Everything really comes through the same way. And so one of the first things I always like to focus on is if you can see the earnings on the left hand side. One thing that's very important for me is to look at the annual earnings growth. And
Right.
so this is the actual earnings per share, and this is
Okay.
how much this changes year over year. And it's very important that the stocks are growing aggressively. No matter
Mm.
what the company is, you can have the best story in the world. Unless they're going to make profits and grow those profits, the stock is not going to be able to go on a major advance. If you look at the greatest companies in the world, they're earnings powerhouses. But
Yeah.
it's really that growth that matters most to investors. Because,
Right.
at any one time, a company is worth what it's worth. It's only what are they going to do from here that really matters. So
Sure.
by initially eliminating the universe, there's so many stocks to choose from. By focusing already on companies that have record earnings, they're growing 20, 30, 40% per year. You're already focusing on companies that have, number one, a product that's very much in demand. You have a
Yeah.
management team that's capable of running this company well and profitably. And typically everything we look at in life is driven by trends. I mean, the internet took hold and it's grown over many, many years. The iPhone became the new thing, and it's gotten more and more an adaptation, and catching on to these trends where you can get a significant amount of your account, into these positions is
Yeah.
where you could really, really, drive dramatic change. Because I know a lot of people like to do shorter term trading. The issue is if you have a stock that doubles, but it's only 5% of your account, well, it's only a 5% account return. So if you really want to change your account significantly, you have to find a great idea and have a big position. And I think if you look at a lot of some of the greatest investors like William O'Neill, Paul Tudor Jones, Stanley Druckenmiller, Warren Buffett, they actually all say the same thing. They like to really concentrate their positions when they find a high conviction idea.
Sure. Sure.
And so if we
So,
take a look at some of these companies here that we're looking at now, for example, it's actually interesting as well. A lot of the same themes that I'm looking at here in the United States and Canada, those same themes are also driving Indian stocks right now, and that's where the strength is. It's very much commodity based, cyclical types of stocks, whether it's oil or coal, agriculture, and part of my approach as well is, as much as I love to focus on individual companies, I always really want to understand the global trends that are happening. Obviously, right now, given the war with Russia and Ukraine and the impact on commodity markets, it's having really big repercussions.
right.
And so you're really seeing that come through inside the different companies. And so you can see, so one of the first companies I brought up, if we take a look at Adani Ports, this is so they engage in development, operation, maintenance of port and port-based infrastructure. And so obviously with a tightness of the amount of shipping that's available in the world, let me just bring the chart over here a little bit. They're definitely benefiting. And you can see this, what I like to focus on earnings, if you look here at the earnings per share,
Mm.
they've already been growing nicely. From 2015, they're making $8.45 a share. 2020, they were at 19 cents a share. So they more than doubled earnings over 5 years. And this year they're expecting $24.50 a share.
Okay.
So I'm not really looking just for the saying is a flash in the pan. If you want something that's sustainable, you want to find a company that's already growing well. And then typically there's a catalyst. There's something that's going to spark that growth to actually increase even more.
Mm.
And so obviously right now, you always wish it's under good situations. That's the spark, but sometimes it's not always the best of situations. And so the fact that we already had these great fundamentals, you can see this is the S&P and the NASDAQ in the upper panel here. Although a lot of markets have been very weak since November,
Yeah.
this stock is held fairly strong, is actually pushing up near all-time highs. And so it's important to know that investors that have a great company that's growing strongly, typically they're not going to sell. And the second the market just stops falling a little bit, the stock will advance very strongly.
Sure.
And so it's
Sure.
that combination of finding these very strongly growing companies, and then after a stock chart that confirms that, okay, institutions, big funds are actually accumulating this stock. That combination of having both sides is really what leads to these high quality, high probability buying opportunities.
Sure. Matthew,
And I think, yes,
Matthew, so sorry to interrupt you in the middle. Just one thing. Can we also discuss this template which you have? Like you have the
sure.
broader index on the top, and I mean, just for understanding of my viewers.
Absolutely. So I tend not to have too many indicators on my chart. So I just always have the general market index on the top. In this case, the NASDAQ and the S&P is most relevant to me. Obviously, if your focus is Indian stocks, you can put the Nifty 50 up here.
Yeah.
And this is a weekly chart. These are the weekly bars. This is the 10-week moving average. This is the 40-week moving average. That's
Okay.
the same on the daily chart. That's the equivalent of the 50-day and the 200-day. So the very standard, most typical moving averages, just to give me a very good sense of the general trend.
Sure.
We have the trading volume for the stock here. And this indicator down here, it just shows how far the stock is from its 10-week average.
Okay.
So although I'm trying to follow trends, if sometimes the trend gets a little too heated in the short term, there's a little bit too much aggressive buying, I want to be able to, not get caught in even that small pullback that's enough to cause, some serious losses. So that just kind of gives me a sense of how far we are from the average.
Sure.
So
Sure.
very, very simple, nothing too groundbreaking there.
And I saw that this one is very interesting. The financials plotted on top of the chart. So this is this a trading view screen, or I mean you have developed it on your own?
Yeah, this is TradingView. The only thing that's this earnings table down here, a
Yeah.
friend of
Yeah.
mine developed for me, and I think he's actually looking to maybe release it soon. His name is John Muchow. He has a lot of great tools. I think his website's tradertoolbox.io. So he's always building these nice little indicators. He's really great at it,
Awesome.
and so it really helps to have that right on the chart. Those fundamentals. Now,
Awesome.
one tool. So once I start with the big picture, and I
Hmm.
have this big picture idea, and that's really important. If I want to buy this stock that I'm going to hold for 3 months or 6 months or 9 months, I want that, like I mentioned, big picture idea.
Sure.
But then after, in my opinion, to be a really great investor, you have to just be a great risk manager. And so you need
Yeah.
that kind of shorter term analysis is what I focus on to actually time my buys and sells. So this chart here is just a little bit different. This is let me get back to the same stock chart. So it's the same chart, but only it's on a daily time frame.
Okay.
The only different tools down here, I guess this is not really relevant. I can take this off right now. I use this tool here for my market analysis. This is the NASDAQ. I look at how many stocks each day are making new 52-week highs and how many stocks are making new 52-week lows.
Nice.
And I like to use that analysis because sometimes the general market, if you look at the NASDAQ 100, 7 stocks represent 51% of the index. So
Right.
if you're not in the biggest companies, the index sometimes doesn't give a very good glimpse of what's going on to most stocks. So
Correct.
by looking at the number of stocks just making new highs versus new lows, gives me some very good insights. And actually, if we take a look at the NASDAQ composite right here, you can see that as the market actually topped back in November, internally, although the market looked very strong, internally, a lot of stocks were already starting to break down and make new lows.
Yeah.
And actually, right off the bottom, as we started to rally, that actually changed positive for a little bit, and now it looks to be getting negative again. But I like to keep at the bottom of my charts just to kind of give me a good sense at all times if the general trend for general stocks is positive or negative.
Sure. Sure. Sure.
So just focusing back on the actual individual stock. So once I determined that we have this great long-term view, this long-term overview, then I kind of flip to the shorter term aspect to see where can I actually buy this stock now with a very low risk.
Okay.
And I think every investor, you always want to think, I always say it's like, you want to be like the casino, not the gambler. You want to
Yeah.
be thinking, you want to have the odds in your favor. And as most individual investors, we're fortunate that you can buy a stock and sell it if you're wrong with a very small loss. And if you're right, you can have these long advances. These big institutions, although they have the best research in the world and the biggest capital, allocations, they can't just get in and out of a stock when they want. It takes a lot of time, takes them weeks or months of buying, same for selling. And so that's our strength. And I think people should play to that. And so once you have this great, understanding of the general trend, I flip to the shorter term time frame and I look for entries, to trigger when to buy or sell the stock.
Okay.
Yeah.
Uh, and typically, these trigger point would be one of those moving averages retracement or some kind of a price demand zone.
So I like to use the averages just for a sense of trend. So one of my very important rules is the blue line here is actually my 200-day moving average. I'll
Okay.
never buy a stock below the 200-day moving average. So I just make sure it's above there. And so once we have the general chart pattern, there's a number of patterns that I like to use. Some very simple ones is you can just put simply a nice trend line over the tops of your charts.
Yeah.
So for example, here, if we just draw this in, let me just get this out of the way here. There we go. And so you can see here, one way that I like to draw my trend lines, I think is very important, is I need 3 important touches. Because if you just draw two touch points. Any two touch points in the chart will be a trend line.
Yeah.
So for it to be a valid trend line, you want to have at least that, so we have one touch, a second touch. I mean, sometimes you can just slightly get above a line. We
Yeah.
have a third touch here. And this third touch is really telling you that this line of resistance is important. It's real. It's a line that's really held buyers back in the past. And
Sure.
so when we break above that line strongly, like we did here, that's one of the techniques I'll use to trigger, to get into the stock. And if you wait for those three touch trend lines and you demand those three touches, suddenly, rather than having lines all over your chart, nothing kind of makes any sense.
Yeah.
You'll see it's not so easy to find three touch points that do a really good job of controlling price action. And so that's one of the many techniques I use to actually buy my stocks.
Sure. So, Matthew, I remember you talked about relative strength and you use the index chart also to see whether the stock is strong or not. So, when you are making that buying decision above this trend line, you're also looking at the depth below, which is number of stocks high, making high versus low. At the same time, you're looking at the index, whether it is also in an uptrend or not, right?
That's right. And I think it's so important that you're positioned in the stocks that have the best relative strength, so that are holding best against the market.
Yeah.
If you put yourself in the shoes of an institutional investor, at any point in time, they have to decide, they always have to be invested. They don't have the luxury of going to cash. So they're always trying to determine which stocks am I going to hold, which stocks am I going to add to, and which stocks am I going to sell. And
Sure.
again, they're always going to be positioning for these longer term trends. So I always say the footprints of these big institutions, and there's so many around the world, they can't hide themselves. Even if the stock is a little bit weak, if
Yeah.
it's not falling as much as it should be falling,
Yeah.
that's a sign that an institution is slowly accumulating stock. I mean, keep in mind, they need to buy stock every day for weeks or months. I mean, when I
Yeah.
was a market maker, a pro trader, the general rule was you can't buy more than 5% of the daily volume without really becoming obvious. And then after, you have everyone kind of trying to run in front of you to buy the stock. So they have
Yeah.
to take their time, buy their stock day after day. And that really comes through that as the market's correcting, the stock doesn't go down or goes down much less than it should. And so as a result, I decided to develop a relative strength approach that could really find that for me, because I found that was just such an important concept. And there's already there's different tools out there for relative strength. But when I was trading back in the day, I was shorter term focused, or because I was based in Canada, some of the traditional tools didn't really work for me. There was
Yeah.
different drawbacks. And so I said, I need a tool that, can work on precious metal stocks. If I'm looking at precious metal stocks, I need a tool that's going to work if it's a low price stock or a high price stock or a volatile stock or a non-volatile stock. I just want
Yes.
to know, when are institutions buying and selling? And so that's what I built here. So this blue background is basically, it shows when relative strength is present in the stock. And what's interesting is that you can apply that to any index around the world or any stock, and it'll display that.
Wow,
And
wow, this is interesting. Is this available for us in India as well?
so it's part of my membership at the moment. So people who sign
Okay.
up to the membership, but I'm looking to, I've been so busy with so many things
Yeah.
recently. I'm looking to find a way to kind of get it out to everyone, but definitely.
Yeah.
And I have a couple of videos on my website where I really go into deep detail as to how I construct the indicator. But
Yeah.
just to kind of provide the concept of how I built this over time,
Sure.
was that in statistics, there's this statistic called beta. And so
Yeah.
basically beta, what it does is to, to keep it not too complicated. If there's a beta of 1, it means that if the index is up by 1%, your stock should be up by 1%.
Yeah.
If the beta is 2 and the index is up 1%, your stock should be up 2%, twice as much.
Yeah.
So this beta number gives a really good insight into how your stock should act. And so once you know how your stock should act, that gives you a good benchmark to tell, is your stock acting strongly or negatively?
Yeah.
And so that really helped me. I said, okay, once I had this great statistic, and I built this over 10 years of thinking about this over and over again. I
Yeah.
said, well, look, if the stock should be up 2% and we're up 3%,
Yeah.
that's relative strength. That alpha is really called alpha. That relative strength is key. And so I took that as my base concept, and I have a couple of time frames within the actual analysis. But because beta adjusts for volatility, and because it has this alpha indicator, you can use this on a stock that has low volatility, like a bank stock. You could use this on a very volatile growth stock, a young, small capitalization stock, and you can very instantly know if we have relative strength or not. And
Awesome.
so it's very interesting here. You see all the Indian stocks that have been so strong lately. You see, whenever the trends actually start to develop, it happens with a backdrop of relative strength. Take a look at, let's say, JSW Steel. You see, in periods of consolidation, the stock is kind of underperforming, and then suddenly we have this really strong push higher, and that's when you want to start focusing your attention on that
And
stock.
and this relative strength inside this chart, the blue one, you are comparing with Nifty because that's the index.
So at this current moment, by default, I always have the Nasdaq on. Let me just take a look if
Yes,
I
yes,
put the Nifty on. Yeah, I could put so if you put the Nifty in there. So I
yes,
use the S&P as my basis, but if you say what's the most important to you as an investor, if you say what's most important is to, I'm not looking to invest in the US markets or the Canadian markets. I just want to invest in Indian markets.
yeah,
Then the Nifty is your benchmark. That's what counts. You want to be in the best Indian stock possible. And you'll see here, it works very well as the stock was here. Let me just take off the earnings for a second. You can see as the stock was in a very strong uptrend, it had this very strong blue background saying there's a lot of relative strength.
yeah,
And as the stocks stopped advancing, and maybe the Nifty was stronger at the time. Let me bring the Nifty up
yeah,
actually up
yeah. You
here
can change that as
for
well
a
to
proper
Nifty.
compare
Yeah, yeah.
for a proper comparison.
Anyway, Matthew, I've been a relative strength practitioner for almost 6, 7 years now.
Okay.
Yeah,
Okay.
yes. I'm so glad to see this model of yours.
Yeah, like I said, I started with these ideas like 10 years ago as a market maker, and it took me enough time to finally get the concept in place. And once it clicked, I was, it's for me, it's a tool I really need on my charts now. And you
Seriously.
can see it's so important because although JSW Steel here had this really strong advance, the Nifty kept advancing over this period.
Yeah,
Although the stock didn't break lower, it stopped going up.
yeah,
And that's that beta comparison. So the tools start to realize, hey, you should be higher. You should be higher. And so so then very quickly said, okay, you're no longer a relative strength leader. And we had a white background. And then as the Nifty kind of broke lower here, and this very quickly turned back up, it started to notice, oh, okay, the Nifty is kind of moving lower, and you're not moving lower anymore, and so we're back into relative strength. So if you had this great uptrend and you could have locked in these profits,
yeah.
after here you could have drawn your trend lines down. Let me actually just draw a trend line down to find some great entries here. Let me just take this line here. There we go. So you had this one touch point, two touch point, a third touch point right here. Let me zoom in a little bit more, and you can see like, okay, so we're in this basing structure. The stock is making record earnings. We're now displaying relative strength versus the Nifty index. This is a stock I think I should be getting repositioned in again. So you could have had your money to work elsewhere or kept it in cash and stayed safe while it corrected. And then after really closely off the bottom, this came back onto your radar. You're saying, okay, wow, the story's still intact, still doing well. And now we see that relative strength. And so it all comes together to build this high probability setup.
Awesome. I have two, three questions here. I think one of the question
Excellent.
you have answered the how to enter and how to exit. So probably the entry point will be above this trend line. What would be the
Right.
stop loss in this setup?
So the way I structure myself is I look for these general basing patterns because I think that it's important that you have this larger base developing. And I guess it's my background as being a short-term trader. I don't like to sit with large losses. I'd rather find another way to get back in than sit with a large loss. So whenever there's a stock that breaks above a line like this, in this
Yeah,
example, if it were to fail and take out the low of that bar, I
yeah,
have to tell myself, I'm wrong. Maybe that breakout was a false move. I mean, as a market maker, many times I'd try and make a stock look good only to actually sell it and bring it in after. And the algorithms do the same process today. And so I would keep a stop loss at the low of the day or at most the close of the prior day. If it gave back all of the gains, I have to acknowledge, look, my thought was that we're breaking higher. That didn't happen. We now reversed all the gains, take a very small loss and look for another entry. And by doing that, when you're wrong, you lose a few percentage points. But if you
sure.
catch a proper trend and you're right, you can make, 20, 30, 40, 50 percentage points. And you do that long enough, and over time, you really just put the odds in your favor to have, sustainable gains.
Sure. My second question is that I understood the stop loss. So what would be your take profit? Would it be in certain times of the stop loss, or you would like to trail with some parameter?
So that's a good question. And this is something that William O'Neill really brought up, and I've never seen elsewhere. So he has something he calls a hold rule. And he noticed going back in his studies, studying the best stocks, that the best companies break out of a basing pattern and advance 20% really quickly within 2 or 3 weeks.
Sure.
And so he realized, he said, typically if a stock breaks out and advances about 20%, you want to take your profits because then it'll correct back to an average and reset up again. He's like, but if it's a rare situation where we have a stock making record earnings, we have relative strength, and we break out and it advances 20% in a week or two, and it happens. I mean, we've seen that many times in the past couple of years.
Yeah.
There's an underlying demand for the stock that is so strong that I have to reassess. I have to stop thinking about locking in the profit, and I have to realize that maybe I have something special, something that's really changing the way we live, work, or play, or it's really keyed onto a specific industry trend that's accelerating. So he's like, in that case, I need to hold. So my sell rules work around that concept. So if I buy a stock and it advances that 15 or 20%, if no hold rules, if no special situation arises, I'll take my profit. If a stock does break out but advances really significantly short term, then after I switch to either following a 50-day moving average, where I say I want it to break below that average with big volume, that way I can give the stock time to advance and work its trend. Or if we get a lot of traditional technical analysis, they call a climax top, a point where a stock advances extremely significantly 9 out of 10 days in a row, and it doubles in a few weeks, then I'll sell into that situation. So
Sure.
if that hold rule triggers, it forces me to sit back and say, okay, I have something more significant here. I want to hold this for a bigger advance now. I want to just give it more time to advance rather than take the short-term profit. And that's how I adjust my selling.
Sure, sure. So my question number three is that Indian market has almost 5,000 stocks, and some of them are large cap, some are mid cap, and a lot of them are small cap. So when we
Right.
are doing this relative strength analysis, do we necessarily do with Nifty, which is the weighted average of the top 50 stocks, which is the best 50 large caps, or when we do it for say mid cap stock? Then do we not take Nifty and take some other index, which is more of a benchmark for a mid cap sector?
That's a good question, and I've actually studied that quite a bit because it's the logical thought to think like, if I'm in a small cap stock, let's just focus on the small cap. But I realized that if you look back, for example, 2021 was a very good example in the United States, where it was the larger cap stocks that advanced very strongly, and the
Yeah,
mid and small cap stocks actually already entered into a bear market for it was been about over a year. And so as an investor, I have the flexibility where I can own a large cap, I can own a mid cap. So by using the S&P as the benchmark, it's kind of always forcing me into the strongest stock and also the strongest market cap sector at the moment.
right.
And so if you just, I would say if you use a mid cap or a small cap index, if you say I'm running a fund or my focus is simply small cap stocks, then you could use a different index. But if you're an investor where you don't mind going to wherever the strength is, which is my situation, I find the S&P as the benchmark is the best way because that naturally will push you towards the right market cap, the right sector, and the right stock.
Sure, sure. And one more bonus question out of this. Do you also look at the relative strength of sector indices before taking an aggressive bet? So if there is a strong sector vis-a-vis market, then obviously you will go all in with the stocks in that sector.
So I think it's important to be aware. Like I don't run the relative strength on the sectors themselves. I like to do it on an individual stock basis.
Sure.
But like as you can see, if you look at some of these stocks like JSW Steel, this is Reliance, is oil, and the ports, it's all very commodity cyclical. So as
Yeah.
soon as you run this analysis, and you can just the trends will kind of start to jump out at you. If out of 20 stocks, 17 are commodity based stocks, that the trend becomes very apparent. And then, but I like to always go a step further. And some people just want to look at charts, or some people just want to look at fundamentals. I try to always understand what is driving this move. So before I get very committed to a sector, and I'm comfortable personally being completely invested in one sector,
Okay.
But I want to understand what's the driving force, because something, markets can change on a dime. Look at the COVID bottom turned higher, and recently we had this strong advance, and now we pushed lower. So if something will come out to change that dynamic, I at least want to understand that, okay, something important has now changed. So, for example, right now with commodities, it's the Russian invasion of Ukraine is having a big impact on commodity markets and just changing completely the dynamics of the international commodity trade. And so in this case, it's a very obvious trigger. It's not always so obvious. But if tomorrow suddenly there were to be peace announced, and the West and Russia came back together, and there was some kind of very friendly, which we all hope that's how this situation ends, then in that case, and I saw my stocks break lower, and I saw sell rules come up, I'd say, okay, I have the technical sell rules, and the whole reason for this trend to have developed is now ending. And so it just gives me the confidence then to say, okay, I need to absolutely sell all of these positions and move on to a new idea.
Sure, sure. So when you sell these positions, so I mean there has to be optimal number of stocks in your position, because when you are selling, you can't have many stocks in your position. So what's your
Right.
assessment of the optimum number of positions one should have?
So I personally, I'm a more aggressive investor, and I have a lot of years of experience. So I'm always comfortable when I have 5 or 6 positions. Once
Oh,
I start getting to 7 or 8, 9 positions, I start to feel like there's a lot to focus on. But the main reason I like having less positions, and sometimes a new trend develops, I'll have 10 positions, and I'll see
mm,
who advances. But after a week or two, it becomes very obvious which are the stronger stocks and which are the weaker stocks. And most people, their natural instinct is to sell the better one, take a profit, and hold on to the slower one. But that's not the way the market works. I mean, the stronger stock is stronger because people really want to buy that stock for a good reason. And so I actually do the opposite. So as after a couple of weeks of a trend develops, I start to naturally eliminate my weaker stocks and force that money into my better names.
sure.
And I usually end up bringing it down to 5 or 6, but the 5 or 6 are quality, and that's how I like to build my positioning.
Sure, sure. Please pardon me. I'm asking many questions because, one statement after another, I get many questions. So pardon me for that. Uh, Follow-on question on this. Now that you only do five, six, or 10 stocks, that means do you build position if you are right in a stock? Because as you said that you want to own a lot of a stock which is right stock for you,
Right.
right?
Yeah, and I think that's so important because when you do this long enough, Vivek, I'm sure you know yourself. Whenever you're sure about something, you're going to buy a stock. After hours, you're going to have this bad announcement that comes out right away. If we take a look at just a stock that I own right now is Black Rifle Coffee. It's a
Oh,
new coffee type company. And so I bought, you see, my trend line is still here. I bought that on this 3 touch trend line, but this
wow.
had a really strong advance a few days ago. If you weren't following, let's say, proper buying technique, and you just bought it out of excitement, as soon as this closed strongly, the next night they actually announced that they were accelerating warrants. So that naturally puts pressure on the stock. I won't get into the whole story about it, but if you would have just jumped in saying I have to own the stock right now, and you put 25% of your account, you're hit with a very big loss. And so
Yeah,
it just seems like that happens more often than you think. So I'm always very careful. I want to have 20, 30, 40% of my account in my best stock, but I don't want it all at once. And so that's why I've developed many different tools. One is the 3 touch trend line, like I described. Some other examples would be, let me bring up, I think I saw one on this chart here. Let me bring this over. Um, I don't see one stand out right now, but I have a lot of
so
other individual patterns.
that's because it's nifty here. So, oh no, this,
No, I was looking for an individual
oh,
stock chart pattern to describe, but I don't see one on it right now. Um, but once you have different technical tools, different entry techniques, then after you can kind of build up your position with time. I'll show actually one that I know I'll find it is Mosaic, for example. Let's go back to Mosaic. So this is obviously a fertilizer stock. There's also, I forget, one of these nifty stocks is also an agricultural based stock. It's doing very well. And so this is actually my biggest holding at the moment. I started buying this here around $40, 39 and change back in earlier in the year. And so another technique that I like to use is if we break above a prior high, technically, let me just put a trend line in here. Okay, so I'll just put a
Mm.
green line in here. Very often, like I mentioned, as a market maker, I know this through experience, it's very tempting as a market maker to break a prior high because most people feel that's the green light to buy the stock. And so you get a bunch of kind of people chasing, and you call them weak hands. They're very easily pushed out of the stock. So it's very often you'll see a stock break new highs and then correct and then eventually have a big rally. So one of the techniques I like to use is if we have a breakout of the highs and we pull back to a 20-day average, which is my green line right here, I like to buy on that failed breakout pullback. So the reason for that is the general basing structure is very strong. The earnings are very strong. But on a technical basis, they break the highs, and this drop is just to shake out the very short-term momentum-oriented traders. And you would think that, there's so much good things going on with the company that, algorithms and market makers wouldn't waste their time, but it's just such a tempting strategy to always shake out people, and it happens all the time. So I will use that as a pullback method to buy the stock. And another pattern that I like to use, I call a mini coil, which is, this is something I developed as a market maker. And you see, you'll have a large range bar, such as this bar right here. And then you have two bars which don't break higher and don't break lower from that first session. And that's significant because if you look at most trading days, you're always taking out a prior day's high or a prior day's low, because again, it's just the natural for market trying to figure out, are we going higher or lower? So to see 2 days consolidate within a pattern, within one range is pretty significant. And so if we break above the high of that bar, I have a very low risk. If this move is going to continue higher, I have an entry. And if I'm wrong and we break lower, I know very quickly. And
Mm.
so you can see, if you build these different patterns, so I have a 3-touch trend line, I have this failed breakout pullback, that's how you can kind of build your position over time and get concentrated, but not have to have all that risk of putting it on at once and being worried about a gap down overnight. So for Mosaic, I bought stock here at this point on the 20-day average. I bought above the mini coil here at 44, and actually bought my last portion here around 55. And so this has been a really nice strong winner. And I have a very concentrated position, but I didn't have to put that whole position on and take that really large initial risk at the beginning.
Great. Matthew, I was wondering, how do you handle those days when suddenly, because of some news, market falls and you have built large position and you see there is a candle which is coming in and you're not convinced because something happened, say Russia happened and the price fell. I think this candle was the one which we see uh, just after
This one
that.
right here, maybe?
Yeah, yeah,
Or
yeah.
here we're talking?
Yeah, yeah. I don't exactly remember the date of Russia, Ukraine. So how do you handle those days when suddenly market has crashed for some news and you have a large position in that stock?
It's not easy. I think everybody will say, oh, if you just bought Apple 10 years ago, you're retired. But, find me people who had a big position in their account at Apple and went through all of the ups and downs and never sold it. It's very difficult. And it's taken many years of psychological work to
Yeah.
mindset focus to get that right. But I think what's really important is you have to start off, like I said, with a really strong foundation as to why you want to buy the company. All of that should be there. And you need a very strong foundation of why I'm going to sell the stock or what's going to trigger a sell. And that's not going to be right 100% of the time. But any business, no matter what even if, let's say, think again, even a casino is extremely profitable, but they have losing bets. So you have to look back and say, with my system, my strategy, what's the most effective method overall? It's not going to be the most effective for every trade. You have to accept that. Nobody can tell with certainty which happens each trade. So once you have your sell rules, like I mentioned, a climax top or a break of the average, this clearly wasn't a break of the 50-day average. And this wasn't a climax top because it had just recently broken out of the base. And this actually was something that I was saying, wow, this is so strong. I need to hold this a little bit longer. And having those kind of rules is what helps you to stay focused and centered. But it's not easy. You have to have a deep understanding of your strategy and why you use your tools. And I think, if you look at, for example, racing or, Formula One, and these guys are going 200 kilometers an hour, inches from each other. And you have to have a strong belief in the car is well engineered and you'll be able to stop if you hit the brakes. If you don't believe that, you won't be able to drive at 200 kilometers an hour. So if you want to capture these big stock advances, you have to have a well-formulated strategy and believe in that strategy and just stick to it like a business person. You don't want to be someone run by emotions. A business person is focused on exercising his business, and that's how you have to approach the market.
Awesome, awesome. I think it's a great analogy which you have given.
Thank you.
And in continuation of that question, see, this strategy which you have is typically a momentum strategy. So you will only enter a stock when the momentum is confirmed, right? But we have seen that most of the time money is made in the market, big money, when the stock is down and out and no one is talking about it because of some reason, and then gradual position building by the big operator or the owner of the company that starts getting in.
Hmm.
So uh, does your model allow people to buy at the bottom, like for example the bottom which was made in say March 2020? Where, how are you placed? Did you buy or you were sold?
So that's a good question. So I was in cash, luckily, throughout that period. If you take a look at, um, it's a good example to see how all of this kind of comes together. If we take a look at the Nasdaq and we go back to that period, let me just bring this back here a little bit. Hard to believe it's already 2 years ago. Um, okay. All right, here we go. You can see the Nasdaq right off of the highs. Let me get rid of right off of the highs here. You went from being a rather healthy market, making most stocks making new highs, to all of a sudden more stocks were breaking down, making new lows. So I actually, I was invested. I was long at this point in time.
Hmm.
And when I saw this, I exited and I got the cash because not only did the market break down, but my individual stocks were flashing sell signals. So I exited the
Hmm.
market. And then very soon after the low, we had what's called a follow-through day concept, which was this day here. Again, William O'Neill discusses that, and it's a very strong up day for the market. That's when it's a certain number of days from the low, and that
Hmm.
is typical what you see at the beginning of new uptrends. As well, my understanding of the Federal Reserve and monetary policy, there was a lot of very bullish factors at that time, and you can see
Hmm.
soon after the market actually started to shift into a very positive mode, and you have these net highs come in across at the bottom. And so we had that. So for example, one of the better trades I had that year was Fastly. And again, if we get back to that 2020, they really benefited from everyone staying at home and kind of being unable to go back to the office and all that. They had these edge server computers to help speed up people
Hmm.
working remotely. And so you didn't. I mean, yes, this bottomed at $11, but if you tried to buy the bottom, you also had the risk of going from 20 to 10. I mean, you don't know where the exact bottom is. But you see, because you're focusing on new trends and stocks doing something significant, if that trend is going to develop, you have plenty of time and a lot of upside. And so I actually started buying on this gap up bar. This was one of the techniques that I use as well.
Hmm.
And my risk was controlled because I know if this kind of were to turn lower, I can exit immediately. But if I'm right on the trend, I have these significant advances. The issue with buying it on the way down is because they call it the value trap.
Hmm.
It was a great
Hmm.
buy at 15. Now it's 12. It's even cheaper. So I
Hmm.
can't sell it. Then it's 10. Oh, it's even cheaper. I can't sell it. And if you get stuck inside, the countless examples of companies that look good and then after weren't, the risk is too high. So
Hmm.
because I buy on strength or I buy with a technical reason, that allows me to control my risk. The issue of buying it on the way down, you have to mitigate risk another way. You have to mitigate risk through position sizing, through diversification, and some of the best, like a Warren Buffett. I mean, obviously, it's an effective tool. But for myself, where I want to have very large annual gains, concentrated positions, I can only achieve that and sleep at night by following this very tight risk management system and exiting when I'm wrong. So that's why I don't buy the bottoms. But sure, maybe you missed it from $12 to $25, but I did catch it from $27 to $130. So, it all depends on what you're trying to capture.
Sure, sure. But there are so many stocks. How do you filter that which one is actually the right moment to buy?
So once you start by looking at stocks making record annual earnings, then I look at those that have the biggest growth numbers. So I prefer a company that's growing at 30, 40, 50% a year. You automatically take your universe of companies from 10,000 to 150. So now you have 150 stocks left. Then you go to relative strength. How many of these are showing relative strength? Now you cut your 150 stocks down to 40. And now of these 40, where do I see a buy pattern? I'm down to 4. And that's how you suddenly create what seems kind of unusable, so many stocks, where do I begin, to having a very, very focused target of where I'm going to put my capital.
Sure, sure, sure. Lovely, lovely. I'm so glad that I'm hearing these from you because it's so much like what I do. Let us talk about a stock which I invested in. There's a stock called CDSL. Could you just search for it? CDSL.
Absolutely. Central Depository.
Yeah.
Okay, let me go back to the current chart.
And we can also
Okay.
plot the earning one, the one which
Oh
you
yeah,
yeah.
absolutely. So yeah, let's start on the weekly. I always like to start on the weekly chart to get the big picture first. I find
Yep.
it's always very helpful. There we go. Yeah, so you can see here actually. I mean, look at these earnings growth. I mean, you went from 821 to 987 to 1086. Okay, we had a bit of a slowdown in 2021, but a powerful move to 1917. And I agree. And you see, that's reflected in the stock. What drives earnings moves? I mean, what drives stock moves? It's earnings or the
Yeah.
company's ability to bring more earnings. And you'll always see that. And so already just beginning with a company that has these great fundamentals, over the
Mm.
past few years, if this would have been your focus, you had this opportunity for these big advances. And yeah, so it's a very nicely strongly growing company.
So my question is, what do I do now? Say if I already have a
Okay,
position, then what do I do? And if I don't have a position, what do I do?
that's a good question. And so the way I approach the market, some people just say, I want to always be invested, always have some kind of portfolio exposure. I want very targeted exposure. And if it's no longer targeted exposure, I don't want to be in it anymore. And so you can see, so for a CDSL, if you notice on the advance, when these stocks have big advances, this is the 10-week average, which is similar to the 50. It basically always stays above that 10-week line. And it's such a strong support area on the advance. And you see, even though it's an Indian company, exact same techniques work.
Hmm.
Now, unfortunately, let me bring back the Nifty on the top here, just so we can stay focused on the Indian market. One thing to notice is that here now, as the Nifty has been advancing and is basically near its highs, this is starting to lose its relative strength. And I think that comes through as well on a daily chart here. I think actually just today is starting to get back into a white background versus the blue background. So, when you're sitting with a very large profit, you can kind of give it a little more space. You can see this stayed above the 50-day the whole time. But now it's having a hard time. The character of the stock is changing. Here we broke below the 50 to the 200, and now we're kind of just right back above it. But if we were to break below, especially this low here, you'd have to start to realize that something's changed. Sometimes the earnings growth becomes factored into the stock price. And then after investors are always looking to the future, and they're saying, oh, when I look into the future, I don't see that same kind of earnings growth happening, and the stock will sell off. And so you'll notice here that the Nifty is basically back to its highs more or less, but this is really starting to struggle now versus its highs. So if I did own this stock, I start to become concerned at this point because it never did that at any other point. Whenever it was under accumulation, whenever there was big buying by funds, it was always outperforming that market. And now that's starting to change. So myself personally, that's even a sign sometimes to just take your profits when you're sitting with significant gains. Or if you say, look, I really have faith in the company, I want to give it a little more leeway, a little more space. Well, then my rule is never own a stock below a 200-day moving average. So if it were to break below that 200-day, that would be my absolute line in the sand. I have to exit the position.
Awesome. Lovely. One more stock. There's a stock
Sure.
called Angel, and these are the stock beneficiary of this whole COVID because people were trading from home. So CDSL is the one of the largest depository which converts the physical share into electronic shares.
Okay.
Let's talk about another stock. It's a firm called it's a stock broking firm. It's called Angel One.
Here we go. And you can see, look, right away, and this is why I was just so happy to build this relative strength tool. Right off of the lows, this started to show relative strength. It was there the entire time. As the stock kind of broke lower and did something, it was out of character. It said, you have to be careful with this stock. We got to this white background. And then here, as this consolidated on the right side, as the Nifty was kind of weakening and this was strengthening again, it showed it as an opportunity for a stock that you should be focusing on again. So I just love right away with that easy background. and how important that relative strength concept, rather whether it's this tool or you do another method. There's different ways to calculate relative strength.
Yeah,
It's
yeah.
such a core. It's such a core part of, I think, of an effective strategy. So let's just take a look again at the weekly the chart. Angel One. I like that name. So again, another couple of interesting things about this is that this is a young company. Most of the most dramatic moves happen in young companies that are doing something new, or are new to the market. When they're new to the market, they're under owned by institutions. Institutions say, "I want to have exposure to that company," and so that
Mm-hmm.
usually adds to a lot of strength. Here, unfortunately, I don't get a lot of market data. So I guess because it was recently IPO'd, so I don't have a lot of data going back in time. So I mean, they are profitable. Obviously, it's a $138 billion market cap. It's a big company. So in this case here, if you at least look at it technically, it's doing a lot of things very, very nice. We had this very nice basing structure right here. We broke higher, and when we broke higher, we did that on advancing volume. That volume really shows that demand and supply. You can see here when we broke higher here, we had this big volume, this big move, and that goes back to like what I mentioned before. Most people, when they see a big initial move, they say, "Whoa, I got to take my profit." It's the opposite. You see, this is such a strong move. That was a signal, like I mentioned before, that you should give this a little more time because there's something special happening. And you went from 500 to almost $1,800, which is a huge advance. And this is really nice that it's still showing relative strength. It's back at the highs way before the actual Nifty is. And so if you're long a stock like this is one that you want to stay exposed to because it's not doing anything wrong right now.
Interesting. Can I ask you about few more stocks?
Sure, sure.
Yes. So there is a bank called Yes Bank.
Okay. Yes, Bank. Oh, nice move higher here. Let me just bring up let's start with the weekly again. So here, I'm assuming there's some kind of news announcement or something came out to cause this spike higher. This is a stock that seems to have been struggling lately with a $56 loss in 2021, and they're expecting a loss for 2022. So I don't know the specifics of that rally from yesterday, but I mean, first of all, like I mentioned, and that's why it's important to have a good strategy because, like I like to say, the principles become universal. And so because I won't buy a stock below a 200-day moving average, you basically, which is the blue line here, the 40-week average, you could have avoided all of this significant drop from $330 to $12, just by saying I don't want to participate below a 200-day moving average. So that's one of those built-in basics in your strategy that just keeps you away from bad situations. And so at least technically here, I can't speak to the fundamentals. I'm not sure if there's something that changed or what the future is saying. At least technically, we're starting to see some more strength. We see a very good volume up move. On a daily basis, we're starting to see some relative strength develop again as well. During this entire time, you never really had any relative strength. And as this is finally starting to base here at the end, you're starting to see some relative strength emerge. So I personally, unless there's some kind of news I'm unaware of that I will learn about some kind of news, I just avoid stocks in these long downtrends with negative earnings. It's not that they can't work. It's just that I'm so focused on being in companies that are executing well, good management teams. That really reduces the risk that today's good news, then suddenly tomorrow's bad news and we have a gap down. So when you're in a company that's already executing very well, it just increases your odds of a nice advance and lower volatility. So moves like this are going to have a lot of volatility around them, and you have to factor that's a big risk to you. So at least technically it's better, but myself personally, until I see some kind of an actual fundamental turnaround, I would still stay away from the company.
Awesome, awesome. And one more stock, Vodafone.
Vodafone.
Vodafone Idea is the name of the company. It's a telecom
Here.
operator in India.
Are they related to Vodafone as well? I think the
Yes, yes,
European. Okay.
yes,
Okay.
yes.
So let's bring up. Okay. So we'll let the. So same situation here. You see, earnings have really been struggling, and the reason you want to avoid companies with these poor earnings is Again, the market price is going to follow earnings. And so, this started to do poorly in 2018, and that drove prices from $70 down to $3. And if you're an institution, you're a $100 billion fund. You want to allocate 1% of your fund to a company. That's $1 billion. Before you put $1 billion in a company, you want to know they're going to be around for a long time, that they're an established company and there's room for growth. And so you want to see that profitability come back. That's why these trends are so driven by strong earnings growth. And so the problem here with this negative earnings growth is that even if it stabilizes and we don't go much lower, until we see a turnaround and some positive earnings, that's also going to limit what your upside is going to be. And so because I always want to be in a stock that has immediate upside, I'm buying and I see upside right now. By focusing on companies that already have those positive earnings, I don't have that limiting factor on top of me where people are not buying the stock without earnings. So again, there's nothing terrible about the company. It's obviously technically it's better than it was. It seems like the company is stabilizing, which is an improvement. But before I would commit my hard-earned money, I would want to see a stabilization of profitability. And two, you can see this is still underperforming the Nifty. So investors are still, maybe they're not selling it, but they're not exactly looking to buy it. And if the smartest guys, men and women with the best research, the deepest capital, if they're passing on it, why would you buy it? That's the way I look at it. If the guy with the person with the $100 billion fund with the best research is preferring other stocks in the Nifty, why wouldn't I go buy the same stocks he's buying? Why am I buying the loser? That's the way I approach the market.
Awesome, awesome. It's such a lovely interacting with you. And I know the more I talk about Indian market, Indian stocks, I think you'll fall in love with this market and you'll be tempted to trade Indian market as well.
Absolutely. Vivek, I always say I'm impartial. Anywhere I can make good money trading, I'll go there. And I actually found it was interesting by looking at the Nifty. There's actually a lot of similarity in the sectors to the Canadian market. A lot of these commodity stocks, bank stocks. So it actually felt kind of like home seeing these kind of sectors represented on the Nifty 50.
That's nice. Good to hear that. And we obviously, I'm hoping that someday you will have some business interest in India because the way you are analyzing the market is quite amazing. So I'm sure there will be many
Yeah.
people who will be willing to kind of take your advice or advisory or whatever form you come into India. People will be excited to get something from you.
Yeah, absolutely. And I've really been since I started my service. I've always been a professional investor, and as a professional investor, you're always looking at fundamental data and stock charts. And the only drawback is you don't get to interact with many people. So it's been such a pleasure since I started offering some education and like I mentioned, a lot of Indian people have purchased the product, and so it's been a real pleasure to speak with them. And they've asked, can some of these tools be made for the Indian market? So, for example, the net highs and lows, to have that for the Nifty. And I'd love to build it. It's just that TradingView doesn't have the data. If I can get the data. But, even speaking with you today, it's a great encouragement. I'll see if I can find some other platforms that would have that data so I can kind of rebuild these tools so people can use them more in India. And yeah, I mean, obviously you can see the same process works anywhere in the world. It could be Italian stocks, Indian stocks, American stocks. It's what drives companies, what drives investors is a universal principle.
Awesome. So Matthew, I don't feel like closing this one, but since you've given me limited time, so I respect your time. But I'm not going to leave you so easily. So I'm going to take commitment from you that we do organize big events, the
Okay.
training events and other conclaves. So we are organizing one in Goa recently, and I'm taking a commitment from you that next quarter when we organize one, you are going to fly from Canada and we're going to have some great time in Goa together.
Sounds great, Vivek. I hope we can make that work out. And I'm glad to be a guest on any of your podcasts or talk anytime. You're a great investor yourself, and you do a wonderful service educating people. I've been looking at a lot of your videos and just fantastic work. So it's a real pleasure to connect with you.
Thank you. Pleasure mine. And thank you so much for recording this one for us. I hope you enjoyed, friends. I thoroughly enjoyed this because relative strength is so close to my heart. I always get goosebumps when I'm thinking about relative strength. I mean, it's like your mother, yeah, who are raising you. So relative strength is like my mother who is giving me money to make money from the market. So great to know that you are also practicing it.
Yeah.
Thank you, Matthew. Thank you so much, and we'll be in touch. Thank you for recording this one for me.
Absolutely. Thank you, Vivek.